We'll start off with the Coin 360, which looks a little bit red, but that's only because yesterday was so green, which was great. So it's nice to see this, having missed last week, that we got a big bounce and things are starting to turn up and turn around as well. So Bitcoin back near, I think it hit 87.5 actually yesterday. So big news there. So we'll talk a little bit about why, and then we'll talk about a lot of things in the second half of this bull run. So I think we're really getting going here. So yeah, let me know in the chat if you guys have any questions, and then we'll get back to those as we continue on here. But let's start off with pump. So the Fed has the FOMC meeting, I believe. Was that today? Yesterday? They decided not to cut rates, which was expected. The market expected that. That's fine. They reiterated that they were planning on 2 rate cuts this year. And Pomp makes the point here that the data is wrong, and the Fed should have actually already started cutting rates. So there's a handful of reasons for this. Let's dive into this, because this is what affects all of our investments. And moving forward, by the way, side note, in the Cliff Notes version of this is I'm very bullish on the rest of this year, because the Fed is going to cut rates and they're going to start doing or eliminating quantitative tightening, which has been kind of tightening the noose on liquidity in the US since 2022. And it really was the quantitative tightening that had created the 2022 bear market. So let's continue on here. So the Federal Reserve decided not to cut interest rates yesterday. I believe this is a mistake on their part, and is another data point proving the Fed is continuously behind the curve when it comes to monetary policy in the modern age. He basically makes the point that they didn't start cutting rates until real inflation was way out of control. The big reason for the Fed's persistent lag is they have a data problem. Not only is the data backwards looking and lacks real-time accuracy, but the economic data is no longer trustworthy. The Bureau of Labor Statistics was forced earlier this year to revise down the number of jobs created in the last year by nearly 600,000 jobs. That's how poor the data is. So it's not only that the only issue is economic data. I believe I've been convinced that you cannot trust any of the data reported. Do you believe the official inflation metrics? Pomp does not. He goes on to say, the new Treasury Secretary Scott Bessent agrees with me. Here's Scott explaining the problem with current economic data on the All In podcast. By the way, side note, I would highly recommend all of you guys subscribe to the All In podcast. It's really fascinating to hear some of the top venture capitalists kind of wax poetic on all manner of things aside from just technology. But they did a specific one, which was an interview with Scott Bessent yesterday. Free podcast, free video. You can watch it, listen to it. But it's really fascinating to hear his opinion. And I was very much happy to hear. I mean, he's a very smart guy. He's been around for 40 years in the finance space and incredibly successful. So he gets it. So what they're trying to do, threading the needle here in the U.S. By lowering the air in the room, if you will, economically, without sending us into a recession, while also reshoring jobs, you name it. It's a big ask. But so far, I think they'll be able to pull it off. But anyway, he basically says, I don't think it gets much clearer when Treasury Secretary being asked point blank whether he trusts the data, and he says no, right? And he's about as high up in the government as you can get in terms of financial decisions. So the problem with inaccurate economic data is it makes the job harder for policymakers and investors, us, alike. How do you decide what to do if you can't trust the data? He brings it back. We always check trueflation, which I'll bring us to in a minute. This brings us back to the Fed's decision to hold rates at the current level. That would be prudent if you were looking at the last CPI report of 2.8% year-over-year inflation growth, right? However, you can't trust that because it's 60 days out of date. Trueflation, which does real-time data tracking from far more data points right from the source, is currently reporting CPI at 1.7% right now, which is below the Fed's target rate of 2%. That means they could drop rates now without it affecting anything negatively. If trueflation is right, which I tend to think is the case, then the Federal Reserve should be cutting rates right now because inflation is not a concern. Put a pin in that because I'm going to come back to that in the very next slide, the very next page here. We need to refinance trillions of dollars in federal debt this year. Homes for the average American family have become unaffordable due to high rates. Businesses desperately want to access cheaper capital. All of this is positively affected by lower rates. Rates are too high. The Fed should cut. But they're hiding behind the government inflation data as a reason to stay at the current rate levels. And if we look at trueflation, I mean, this thing fell off a cliff once Trump took office. 3% down to a low of 1.3%, which is crazy, and then a little bump back up to 1.7. But that is a massive fall. I mean, if you look at what happened during the COVID era, we had this huge expansion, huge fall. We've been kind of treading water around 3% for a couple of years, and then dropped off a cliff. So that does arm policymakers to lower rates. When they lower rates, more liquidity gets in the economy. Risk assets like crypto go up, and that's generally good for us. The interest rate on mortgages go down. That unlocks the market because a lot of people are frankly just not going to buy a house at 6.5%. I read a study that most Americans surveyed would be comfortable getting into a mortgage at 5.5. That's like the highest they'll accept. So we need to drop those things. Anyway, actually, I'm going to pop over here real quick because it's relevant to what we just talked about. I got 3 pop newsletters for you today because they are very relevant. Perception becomes reality. So there was a big market drop. Everybody got real freaked out last week when the stock market kind of went. I mean, it had been in pretty much free fall since Trump took office. Tariffs have rattled everyone. Fears of recession is rattling everyone. But this has to do more with fears of inflation returning. So, new polls over the weekend suggest that perception from the population is significantly different than mainstream media coverage would suggest. So, this is from March 17th, 3 days ago at this point. Two interesting political polls trending simultaneously on X right now. NBC poll: 44% of America see America as on the right track, the highest since 2004. CNN poll: Democratic Party favorability drops to record lows, blah, blah, blah. He's basically saying that capital allocators really have a hard job to do, right? Because you can't really go by vibes. You have to go what people are actually taking action wise. So, a recent Apollo report claiming consumer inflation expectations have risen at an unprecedented rate. Americans believe inflation is going to come back. This is the case even though inflation is likely crashing under 2% right now. So, here is the expectations by Americans is what's going to happen. So Trump gets elected, tariffs get in, and those are inflationary for sure. Expectations of inflation are through the roof. Whereas, meanwhile, actual inflation is down in the dumps. So, how do we reconcile this? Well, at some point, if business owners and consumers begin acting like inflation is coming, then the odds of inflation rising increase because individuals start hiking prices and allocating their capital in anticipation of incoming inflation. So basically, it's the self-fulfilling prophecy. Everybody goes, "Oh no, I think inflation's coming," and then by those actions, they start creating inflation. So anyway, one area you can explicitly see perception being acted on is high net worth individuals buying the stock market dip. So the stock market dropped pretty damn hard not too awful long ago. In fact, I'll pull this up in tradingview.com. I might have to log into this, guys. So yeah, okay, let me do this for a second. Pull this off screen so I can do this. One moment here. Thought I was already logged into this. And I'm going to go to the S&P to kind of show you what he's referencing. There we go. Okay, so let's get back over here. Here's the S&P. Let's go to super charts. And okay, so S&P, people bought the dip, right? So if we look at this move in the overall stock market, this is a big move, right? This is actual technical correction territory. 10% is considered a market correction. We hit negative 10% in the first 2 months of the Trump presidency, which is a pretty bad start, a pretty steep decline because of the stupid ass ideas around tariffs. So you can see though, however, March 13th, people bought the dip hard. They really, really bought it with convincing volume. Wealthy individuals are rushing into U.S. stocks. Affluent and high net worth individual inflows into U.S. equities hit 2% as a share of Bank of America's assets under management last week, the third highest on record. So think about that. Those with capital to deploy bought the dip at the third highest level on record. That's wild. Such a surge in purchases has not been seen for 2.5 years when the group inflows hit 6% of assets under management in September 22, near the bottom of that bear market. So if we go back and look at September of 22, here it was, right here, this big drop in September. That is when they had a record level. People were buying that dip. Now notice they didn't buy the exact dip because the exact bottom didn't happen until mid-October, but people deployed massive capital right around here buying that dip, and that was the bottom, right? And so we just saw this massive buying of the dip right here. That was pretty interesting. Recent inflows were also just shy of those posted in January of 2021. High net worth individuals are adding stocks to their portfolios as the S&P 500 has recorded its fastest 3-week decline since 2020. Wealthy investors are deploying cash. Look at this. Buy the dip reigns third weekly largest inflows to equities ever with their clients. January of 21, which was the very start of that massive boom year in 2021, the massive dip, basically the bottom of stocks in 22, and then March of 25. Huge amount of buying the dip there, right? So that's really good to see them come through with convincing volume. If you think inflation is coming back, then what do? You get out of cash and you start buying investment assets as fast as you possibly can. The Apollo report is telling us inflation expectations are surging. Stocks are simultaneously falling, which is creating the perfect entry point for wealthy investors to deploy their cash and position themselves for future potential inflation. He says, here's the interesting part. I don't think that inflation's coming roaring back. Quite the opposite. True inflation is reporting the real-time numbers 1.68 as of yesterday. Of course, that was a couple days ago. Now we're at 1.71. But that was really interesting to see. So Treasury Secretary Scott Bessent publicly posted yesterday, our administration and the American people are focused on the real economy, not fake news, polling, or vibe sessions. Basically recessions that are vibey, but not in the actual data. After 4 disastrous years of families and workers, President Trump has the track record and the vision to deliver the most vibrant economy and capital markets in world history. I don't know, he's off to a pretty bad start so far. Few data points suggest this is working, including gas prices hitting a 4-year low and egg prices dropping more than 25% in recent weeks. These welcome developments for millions of Americans don't tell the whole story, but they definitely signal relief. The key challenge for investors, aka us, in this environment is to stay on top of the day-to-day or week-to-week changes. Tariffs are on, then they're off. Inflation high, now it's low. Things are changing at a rapid pace. I will tell you that having run Moonstream since 2018, it has definitely gotten harder to keep track of just the massive amounts of change happening on a minute-by-minute basis, much less month-to-month. For better or worse, I would say that the current administration has probably gotten the most done, whether for better or worse, of any president since I've been alive, as far as just speed of action in the first 100 days. It's been kind of dizzying. Anyway, Pomp kind of reiterates here, buy great assets, hold them for a very long time. The short-term gyrations are noise. Those who can ignore the chaos and uncertainty while holding resilient assets will do just fine. I tend to agree. So yeah, we've seen a big bounce right here in the S&P. We've seen a decent bounce here in Bitcoin. I mean, really what I want to see and what I've said is I want to see Bitcoin over 85, and I want to see it hold 85. You can see this is an important level right here. It happens to be about the 200-week moving average or exponential moving average, which we, so far we rejected a little bit on today. But yeah, we need to keep that moving.
Hey, this is Brett from Moonstream. If you'd like to learn more about our pro trading signals or our live classes every Wednesday or our Retire Rich program, go over to moonstream.io/start.